Welcome to Financial Insider Weekly. I'm your host, Michael Gray, CPA. My guest today is Phil Price, and Phil is an enrolled agent. He's licensed to represent clients before the Internal Revenue Service. He has his own pension consulting firm, which is called the Price Company, serving small businesses in Northern California. Phil, thanks for joining me today.
Well, thanks for having me, Mike.
So today, Phil and I are going to be talking about retirement plans for closely held businesses. Today is October 25th, 2016. Before we get started, we're just going to hit some highlights here, and this is intended to be sort of an introduction and to encourage you to continue the conversation with a good qualified pension advisor, a retirement plan advisor. Phil, thanks for joining me today.
Sure.
Okay. Phil, why is retirement planning important for the owner or owners of a closely held business?
Well, there's various reasons. One, employee retention, offering a good benefit package for their employees, retain good employees. Also, saving for retirement for both the employees and the owners. Tax deductibility. Qualified plans are the only way you can get a tax deduction and save for retirement. And then the monies that are in there accrue tax deferred until such time as people take them out at retirement.
And now we have the other choice, the Roth 401k account.
Well, that's true.
So
You could have Roth 401k and put
so-
after-tax money in. So.
Right, so then you don't take the tax deduction, but it grows tax-free, so.
And you never pay the taxes on the other end,
Yeah, and
which
so.
is real nice.
Yeah, it is, and especially for your younger people. So my daughter, for example, who works with me, she's shoveling money in into her Roth 401k, which I think is really great. So we've talked about the Roth, but what are the basic types of qualified retirement plans? And maybe you can tell us a little bit about, contribution limits, maybe basic advantages and disadvantages for each type of plan.
Okay. Well, I guess the most basic is an individual retirement account. That's a personal retirement plan. Limits there are $5,500 per year. And if you're 50 and over, you can put an extra $1,000, so $6,500 in there. I guess the downside on that is it's a lower limit than other plans. A simplified employee plan, a SEP, it's also an IRA type plan, but it's funded by the employer. The SEP is just the vehicle that's used to fund the IRAs into the employees' accounts. Then there's also a simple IRA. Could be a simple 401k, but you have lower limits in a simple 401k. Might as well be in a regular 401k, just my opinion. But a simple IRA, again, is a place where employees can put some money in, and there is either an small employer contribution, 2% across the board, or a match up to 100% up to 3% of pay deferred into a simple. Then there is 401k plans. 401k plans allow for employees to put money out of their paycheck into the plan. The limit there is $18,000 this year. I'm not sure what it will be coming forward. They haven't put out the cost of living adjustments for 17. And if you're 50 and over, you can put an extra $6,000, so a total of $24,000. There's also matches. The employer can match 401k money, and the employer can make a profit sharing contribution, which is an employer contribution. There's also plans that are just strictly profit sharing plans where the employer funds that.
Okay. And then there's the defined benefit plan. I guess we don't see it quite so much, but
Right.
for some small employers in particular, like doctors and so forth, kind of popular.
A defined benefit plan is good for an owner who's older and hasn't saved for retirement. Allows for higher limits of money to be put in than a 401k or a profit sharing plan. It's really ideal nowadays if it was a one-person plan, one-owner plan. They can do a defined benefit plan. They can do a 401k plan with it, and they can do a little profit sharing in there, and they can also do an after-tax contribution in there and convert that to a Roth and hit the total limit on both the defined benefit and the 401k profit sharing plan. So for a one-person plan, you can put quite a bit of money away if you do it the right way.
Right. So the defined benefit plan is more like Dad's pension.
Yeah, it's a lot like a defined benefit plan is the classic pension plan where you get your gold watch and your pension at age 65, so that it pays you a monthly benefit. In the realm for smaller businesses, it's a way to put a good deal of money away closer to retirement. Again, like I said, for someone who hasn't maybe saved up until that point.
Right. So the idea again is your instead of having a contribution amount, that's why we call it defined contribution. Instead, we're funding a benefit, so that's why a defined benefit.
Right.
And so we're funding like X dollars, and it's based on years of compensation.
Yeah, years compensation with the monthly benefit. It's kind of like Social Security pays you in a monthly benefit. If anybody's seen a Social Security statement, it says you've earned, $1,000 a month at retirement. That's the kind of thing we're trying to fund to in a defined benefit plan.
Right.
It's a monthly benefit.
And like you said, we can do some mixing and matching with these plans, except for the SEP and the Simplified Employee Pension and the simple plans. Those they're sort of standalone.
They're kind of standalone.
You either got that or you don't.
Right, right.
Okay. How do you go about having a plan created if you're an employer and you want to start one of these things?
Well, you have to have a plan document. And the plan document sets up all the rules, how do you get in, how do you get out, how do you fund, and other kinds of rules that you have to follow while you have that type of retirement plan.
Mm-hmm. And so in the past, I imagine there's a lot of people that have been going to, for example, because people are selling these plans. So like maybe they might go to Merrill Lynch or Morgan Stanley or whatever.
Yeah, if it's a financial institution, it's generally going to be a simpler document. It's going to have less options in it. Financial institutions also going to require you to keep the money there if they're sponsoring the plan. Whereas if you're in a custom plan, you can have investments in various places, and you can pretty much take into account any type of investment that's legal under the law. It doesn't have to be limited to certain items.
Right. So you have more alternative investments that for example, you could invest in real estate in your plan if you wanted to.
Sure, real estate, limited partnerships.
But if you did it through one of these other companies or through a bank, they're going to have more limitations on the type.
Correct. They don't want to keep the money there at their institution.
Okay. What are the non-discrimination and top-heavy rules, and how do they interrelate with plan administration?
Well, in all these plans, there's non-discrimination testing, meaning when we look at either owners or highly compensated people compared to the rest of the workforce, it has to meet the limits that the IRS has established. Basically, you can't set up a 401k plan, put money out of your check, and not have to worry about the employees putting some money out of theirs. So that's just one example of one of the tests for non-discrimination. So, and the top-heavy test is pretty much everything is now included in plans. Used to be a big difference before 1986. One is there's a required contribution if the owners are going to have contributions, and that's where the owners have 60% or more of the assets in the plan. Then it becomes top-heavy. And that's pretty much the only item now that kicks in as a minimum contribution that's required.
Okay. Maybe we can talk for a few minutes related to some of the things that have happened recently that have an impact on these plans. And I guess the hot thing right now is not so much for the plan, the company, so much as for the providers of different services. Is this fiduciary rule?
Yeah, the new fiduciary rule, they put out a final regulation. The Department of Labor did. They had a proposed a year ago during the summer. Final came through this spring and becomes effective next year. Basically, it's setting the standard for investment advisors who are paid. That's the big key, is you are paid to give advice to the plan. Then there are certain rules that you have to follow there. It's rather complicated, Department of Labor was a little bit overzealous maybe in some of their things, but the purpose of it is so that the investment advisor is looking out for the benefit of the client, and trying to do the best job for the best expense or pay for the plan itself and for the participants. Mm-hmm. And it is making a big difference in the investment world. Most things I think are going to go to a fee-only type situation if it's in a retirement plan, as opposed to commissions or things like that.
Mm-hmm. So forget the backloaded funds, or
backloaded funds, at least for retirement plans, I haven't seen in a lot of years anyway, but still, not a lot of backloading, front loading, or any of that kind of stuff is probably going to go on anytime in the future.
So
when it comes to a retirement plan.
Okay. Is there an Obamacare influence on retirement planning?
Well, I mean, it's another item that takes money from profit. When we're looking at our expenses. If there's a mandate that you have to cover people in health care and you have to pay for it, that is going to chew up more of the income that somebody has. So then there's less money possibly for funding in the retirement plan.
Okay. I see what you're saying there. So, in other words, employers are having to pay more for their medical benefits that they have to apply, and more employers are having to provide medical benefits to their employees, and so that is all having an effect on this retirement planning thing.
Yes.
Another thing, I think have it on the list here, but what about this net investment income tax, and how does it interplay? So some people call it the Obama tax. I don't know what other names that they have for it, but anyway, it's this 3.8% on net investment income when you have more than $250,000 of adjusted gross income for married couples.
Right. Well, and
$200,000 for singles.
Yeah, and that's outside of a plan. Whereas if you have your money inside the plan, you don't have to pay that. And even on the income that you would take out at the other end, you still don't have to pay that tax. Right. So there is an advantage to having the money inside a plan, and you would, at this point, you would never have to pay that particular tax as far as having money in a retirement plan instead of outside of it.
Right. So, for example, if you received interest income, let's say you were holding second trust deeds in your retirement account. Well, if you held those personally, that interest may be subject to tax. Up to the basic tax, with almost 40%. But then you also have this net investment income tax of 3.8% on top of that. But if you wait until after you retire to take the money out, that money, even if your income is still pretty high, it's not going to be subject to the net investment income tax. It'll still be taxed as ordinary income.
Right. But, and that's the other interesting thing too about putting money away into a retirement plan, is that you do not pay the Social Security on that. I know one of my employers specifically puts lots of money in the plan as a bonus, because he doesn't pay the Social Security, employee doesn't pay the Social Security and Medicare tax. They pay income tax when they take it out, but there is no Social Security or Medicare tax at the other end when you're retired and taking money out. So you escape that, as opposed to paying a bonus to someone if you put it into the plan. Yeah.
I think the 401k is still subject to Social Security.
Oh, that is. I'm talking about an employer contribution.
Yeah, regular employer contributions aren't. Okay. So, how do third-party plan administrator companies help compared to plans administered by brokerage companies and so forth? So, in other words, what's the special role that you provide related to the clients that you're...
What we provide, and other firms like mine provide, is ideally they pretty much do soup to nuts on all the administration things that have to be done for a plan. Mm-hmm. If you're with a brokerage house, financial institution, it's going to be up to you to be able to do that. You could hire a third-party administrator to help you with those types of things, but generally speaking, that doesn't happen all the time. And there's special testing and things that have to be done, deductibility, who's eligible, who's not, and that's what the third-party administrator does.
Mm-hmm. And I think a lot of it, though, again, maybe we talked a little bit up front, is the customization in the first place, and the planning aspect of this.
Correct.
So you may have a doctor that comes to you and you said, I just had a windfall. I had a number of big operations I had to do last year, and I've got $1 million of income. What can I do? And it comes to you. And
well, and again, that's where a defined benefit plan may help a lot. Yeah, and also how the allocations are done. The plans that are going to be with a financial institution are generally going to be, again, limited, like I had previously stated, and you may only be able to allocate things simply, where everybody ends up with the same numbers, as opposed to a custom plan where you can choose different contribution levels for different participants based on the testing that you do and what you pass on that. And those plans are going to be limited on what the options are. There may not be any participant loans, hardships, or any of these types of things, because they want to make sure that pretty much that something can't go wrong per se. When they limit the options, there's less things that might go wrong.
Yeah. And also, I understand you can actually adjust plan design so that you can maximize the contribution for the principals in the business. So.
Correct. Yeah. Again, back to the testing, and those are only going to be in a custom plan that's going to allow you to be able to do that.
Right. So, what annual forms are required to be filed for these plans?
Well, there is a return for every plan. It's called a Form 5500. It's an informational return. There's not any taxes involved or anything, but they ask certain questions about, did you pass this testing, certain transactions happen or not happen, and ideally you say no, they never happen, because you don't want those transactions to happen. But it also talks about how much money was put in, what the value of the plan is, how many participants are in it, things like that. I do know, and I'm not sure which way they're going on this, between the IRS and the Department of Labor, they were going to add a bunch of new questions. Now maybe they're not, maybe they are, who knows, on some of the testing and things. I've just read different things on it all the time. So, but the Form 5500 is done, like I said, it's a return for the plan. There might be Form 1099s if somebody's paid out. There's a reporting that there was a distribution from the plan. Mm-hmm. And even if it's a rollover, that form is done, it's just coded that it's not taxable because it was rolled over, as opposed to being coded that it's taxable and somebody has to pay taxes on it. Mm-hmm. There's a few various other forms that have to be done. Those are kind of the basics on an annual basis.
Now, what if a plan covers more than 100 employees? Aren't there's some special requirements there?
Yes, if a plan covers more than 100 participants, then there has to be a CPA audit of the plan, and the actual schedule that goes with that is a much longer schedule that's much more intricate as to the questions that ask and the detail on the plan assets, what things are invested in, and that type of thing. And then, as you know, you're a CPA. A CPA has to sign their name, so they're going to be very detail-oriented in doing that, and it does cost a good amount of money.
Yeah,
$8,000-$10,000 sometimes. Yeah, for that,
or more, depending. I mean, General Motors, you can imagine.
Well, yeah, for General Motors, it's even higher for that. So.
But anyway, so there can be some substantial expenses in maintaining these things, and maybe we'll circle around to another thought I had in a moment. But also there's another entity that we didn't really talk about, and that's employee stock ownership plans, or ESOPs.
ESOPs, yes. An ESOP's like a profit-sharing plan, except that you are investing primarily in the stock of the employer. So it's only going to be for corporate plans. If you're a partnership or sole proprietor, you're not going to have an employee stock ownership plan. You don't have stock. And we do specialize in those. And the advantage is it's a way to pass on the company to the employees. It's somebody, quote unquote, you're selling to, as opposed to an outside buyer. If you're at that point where you're going to get out of your business. We always promote that there's participative management. It gives the employees a feeling being an owner of the company. All the statistics show that when that's done correctly, there's higher production, more profit than a company that is not participative and not an ESOP. And you can do one or the other, but it's best to do it together because participative management, you get the payoff with the stock. And ideally, the value of the company goes up, value of the retirement goes up.
Yeah. So when you have one of these ESOPs, don't you have some special requirements that you need to deal with there? From
Well,
time to
yeah,
time?
on an annual basis, on a closely held as opposed to publicly traded company, you do have to do an appraisal of the company, of the shares that are inside the ESOP by an independent third-party appraiser, so that there's nobody can play any funny business with how much they think a company's worth, and that type of thing. So.
Right. Now, related to this also, in a sense, in some cases, the company, I think, can print its own money that it can contribute actual stock to the plan.
Right. In a corporation, you're going to have a number of shares that are authorized, but you may not issue all those shares. So it is possible in an ESOP to issue shares that are authorized but have been unissued. It's a paperless transaction. You get the tax deduction, and the shares go into the plan.
Right. So these shares are worth X. You put the money in, or the shares in, and then you get a tax deduction.
And it doesn't hurt your cash flow.
It's not coming out of the bank. So that's an interesting concept. One of the places where companies, like I said, can, in a sense, create money themselves.
Correct.
Yeah.
Correct.
Kind of amazing. Okay. So maybe you could talk a little bit about, a little case study or something, somebody that you've helped with one of these plans and in an interesting way, that a result that they've gotten.
Well, yes, one that I can think of, we have a family that owned a company, and they were one of the combinations defined benefit 401k, and I know in one of the years the range of contribution was between 400,000 and 1.3 million. I think they opted for about 500,000 or 600,000 because you have to actually have the cash to put it
Right.
in. But that was for mother, father, and son and daughter who were all in the business, and I would say about 95% of that was going towards family members as far as that goes. The employees received all the contributions that were required, but the mother and father were very close to retirement age, so that was something.
So it's a
that
defined
helped
benefit plan because you have younger employees
Yeah,
that were involved.
younger employees, because
And with the combination of the older, then that actually enables you to put larger contributions in. For
correct,
the
because
seniors.
they, in this particular case, the owners were older, closer to retirement age, and so they needed more funding than, say, someone who was 30 or 40 years younger who has more time as far as funding for a retirement plan goes.
Right. So we're getting to the end here. Maybe you could throw out some final thoughts related to these, small business plans.
I will say that whatever we're talking about today, it might change. We have an election coming up,
Okay.
and we don't know which way that's going to go. We
That's
don't know what the
something I was
Congress
going
is
to
going
ask
to be.
about. Yeah.
The talk is right now there's some things that could happen in the lame duck Congress because they have another budget reconciliation act to do, and that can involve retirement plan numbers. The word on the street is they're going to do tax reform no matter what happens, and tax policy and retirement policy are not always on the same page, because retirement policy is taking money away from the government because you're getting a tax deduction when they try to balance the budget. So at least people in my world, we're going to try to make sure we hold on to what the retirement plan deductions and everything are that we have right now, because they're the best that there's ever been. And there's you have to have an incentive to do those types of things. The surveys show that when there's no retirement plan and no incentive, less than 5% of the people save, whereas if you have a plan, upwards of 70% of the people will save for retirement. So,
it's really important, especially when we have questions about what's going to happen with Social Security in the future and so forth.
That's right.
And so they've actually, though, been talking about trying to restrict the amount you can accumulate, like in an IRA and so on.
Yes.
So it's a little crazy. We all have to keep our eyes open.
Yes.
Phil, I want to thank you so much for joining me.
Okay. Thank
and
you for
coming
having
into
me.
Phil came here all the way from Fresno to San Jose, and it was an adventure today. So, so thank you for that. Folks, we'll see you next time on Financial Insider Weekly.